Discovery is next. So we know what Discovery is all about. It's a financial services company that started its life as a medical aid administrator, but under Adrian Gore's leadership, it's gone into all sorts of other things, most especially its technology-driven model of life insurance and the application of the Vitality point scoring system to try and squeeze margin and get people to behave better and look after themselves. International, all sorts of things going on as well. Market capitalization, 76.74 billion rand. So it's done well, but not especially well lately. Price earnings ratio higher than the rest of the industry, substantially higher, 21.15. Dividend yield, substantially lower. That's the other side of the same coin, 1.47%. So everybody loves these guys, but the share market hasn't quite loved them as much in recent months.
Yes, so the high metrics you refer to is an indication that Discovery has been the strongest grower of all these companies. They've grown the strongest, and the expectation is they'll continue to outstrip the growth of their competitors. But also, we talk about PEs and dividend yields. We haven't spoken about embedded value, which is another way of managing these companies.
It's a very hard thing, you know, that's why I don't talk about it.
Well, they give you the number. Thankfully, you and I, who are not actuaries, we don't need to recalculate it. But you do need to know one or two things about the assumptions that go into that, because for some life assurers, you can justify embedded value as where the share should be traded, and for others, you can assume a higher than the stated embedded value.
Premium to embedded value. Guys like these usually do trade at a bit of a premium.
Correct. Because of the growth component, or in the case of Sanlam, because you think their assumptions are maybe a little bit too conservative. So when it comes to Discovery, we know Ricky Farber has made the personal decision to move to Australia.
He's the CFO.
Correct. He played a critical role in Discovery, but they've got a great team there, so I would expect that someone else would fill his shoes with the right strategy and knowing the culture of the business and looking for growth. And I do think that in the short term, the sensitivity to interest rates for Discovery is higher than other life assurers.
Why is that?
Well, if you look at the portion of the book that comes from future value, it is greater because of the higher growth, which means that there's a higher sensitivity from an actuarial perspective
if you apply
to a change in interest rates
going forward.
Correct.
Okay, but now we know that Discovery Life has been tremendously profitable because they've tended to write good business and they've been able to get people with all the Vitality active rewards and all that stuff to get themselves a bit more healthy, and that works well for everyone. How much of an opportunity is the UK business if they can bring in the same thing? And secondly, how big do you think those foreign ventures with Ping An and Generali and John Hancock and all the others are going to be?
So the first thing is, we speak about life assurers tonight as if that's a monoline business. It's not. Discovery also has the medical aid administration business, the short-term insurance business, the invest business, and a few other smaller, more incubated businesses that they're growing. The bank is also coming off the card business. So what brings them all together is the Vitality program in the middle, which creates the right incentives. I think that means that all these ventures can become very profitable and much bigger than what they are at the moment, including the offshore ventures. So the UK is the one where they've expanded the most, first with the most capital, and therefore could become the biggest.
The most money put behind it.
Yes, the others where they've gone for, call it the capital light way of expanding with just Vitality, is a good way if you are capital constrained because you're putting your capital somewhere else for growth. But it does mean it will take longer to move the needle.
And it also means, as though, as you say, that your returns, even if the Ping An thing does really well, the net flow back is not going to be as substantial as if you actually owned the business in itself.
Yes, so I think investors need to be patient about those.
Okay, let's look at the share price, because it goes as high as like 150 rands a share in 2015, but this year it's sort of drifted around. It's currently around 120. And its results in this period have also been marginally disappointing. People have been a bit anxious about higher provisions for expenses in certain of the rollouts, specifically in the UK. Having said that, there's a lot of potential growth drivers in this story. So how are you going to call it?
So the core business I think is strong. I think has got a lot of growth as they try these new venues and expand on these new operations. The share price for me was too expensive at 150, so I would have said at that time not hot. But having retraced now more to this level, the 120s, I think it's back in hot territory again.
Excellent. What a good decision. I'm hot on that one too, because I'm an absolute sucker for these kind of technology, healthcare type crossover businesses. Okay.